Starting a business in 2026 requires far more than just a profitable product idea. The regulatory landscape has shifted significantly regarding transparency and corporate reporting requirements. New entrepreneurs often underestimate the aggressive data sharing between global banks and tax authorities. Ignoring these structural foundations now will guarantee expensive legal cleanup costs later. You must accept that the era of flying under the radar is officially over. The IRS and the Treasury Department now have unprecedented visibility into your financial movements. If you are launching a U.S. LLC this year, you are immediately on the clock. Failing to file specific disclosure forms within 30 days can result in severe penalties. Many founders focus solely on revenue and neglect the compliance engine that protects it. In this video, you will learn the essential tax pillars you must build from day one. Global banking standards have evolved to make it difficult for opaque businesses to survive. You need to understand precisely how your entity is classified for tax purposes. A simple mistake in your initial setup can haunt your business for years. We will cover the critical steps to secure your assets and ensure compliance. Are you prepared to handle the strict reporting obligations of the Corporate Transparency Act? This mandatory federal filing is not a tax return, but it is equally critical. You are watching Tax and Borders, an educational channel about U.S. taxes and cross-border business. Your priority is to determine the appropriate legal structure for your business model. Most entrepreneurs default to a limited liability company without understanding the tax implications. An LLC is a pass-through entity, meaning the tax liability flows to you personally. This is beneficial for many, but it is not the perfect solution for everyone. If you are a high earner, a single-member LLC might result in heavy self-employment taxes. You may eventually need to elect S-Corporation status to optimize your tax efficiency. However, starting as an S-Corp immediately is often a mistake for new businesses. You should wait until your profit justifies the administrative cost of running a formal payroll. You must also understand when your LLC becomes a partnership for tax purposes. Adding a second owner changes your filing obligations and reporting deadlines. Foreign owners face an entirely different set of decision points when forming a U.S. company. If you are not a U.S. person, owning a U.S. LLC does not automatically make you taxable. You must apply the standard of effectively connected income to see if you owe taxes. This depends heavily on whether you have a permanent establishment or employees within the U.S. Do not let a generic formation service decide your tax destiny without your input. The second pillar of your strategy must be strict financial hygiene from the very first transaction. You must open a dedicated business bank account before accepting any funds. Commingling personal funds with business revenue allows the IRS to pierce your corporate veil. If you are audited, the IRS may disallow your business deductions for lack of separation. Banking access for non-residents is becoming tighter in 2026 due to updated compliance regulations. Banks now require substantial proof of business activity and often a physical U.S. address. You should secure your banking relationships immediately after your company formation documents are approved. If you operate digitally, you must also track your physical location for tax residency. Digital nomads often assume that leaving their home country eliminates their tax obligations. This is a dangerous myth that leads to double taxation or tax evasion charges. Most countries consider you a tax resident if you spend over 6 months there. Some jurisdictions trigger residency much faster if you perform work locally. You must also prepare for the Beneficial Ownership Information Report filed with FinCEN. This requirement forces you to disclose the personal identity of everyone who owns the company. New companies formed in 2026 have a very short window to file this report. The daily penalties for ignoring this requirement are severe and accrue rapidly. This is not a form you can ignore or delay until the end of the year. You need a secure way to store copies of passports, IDs, and ownership percentages for every owner. If your ownership changes, you must update this report promptly to avoid violations. Failure to do so can turn a simple paperwork issue into a criminal investigation. Another critical area is understanding the difference between employees and independent contractors. The Department of Labor has tightened the rules on who qualifies as a contractor. Misclassifying a worker can lead to massive back taxes and payroll penalties. If you hire global talent, you need a robust contract that clearly defines the relationship. You are not required to withhold U.S. taxes on foreign contractors working entirely outside the U.S. However, you must collect a Form W-8 to prove their foreign status to the IRS. Without this form, you are personally liable if the IRS demands backup withholding later. Do you have a system in place to collect these forms before issuing payments? Your accounting software should be configured to track these vendor details automatically. Waiting until tax season to gather vendor documents is a recipe for administrative failure. You should also obtain Form W-9 from every U.S. freelancer and service provider you pay. This allows you to issue 1099 forms on time and avoid penalties for late reporting. We must also discuss the state-level economic nexus if you sell physical or digital goods. You may owe sales tax in states where you have no physical presence. Once your sales volume exceeds certain thresholds, you must register and collect sales tax. Tracking these thresholds manually is nearly impossible for a growing e-commerce business. Automated sales tax software is essentially a mandatory tool for modern online sellers. Ignoring state taxes is dangerous because there is often no statute of limitations on unfiled returns. A state auditor can go back 10 years or more if you never registered. You must also consider franchise taxes and annual report fees in your state of formation. Many founders forget these charges and suddenly find their company listed as administratively dissolved. A dissolved entity creates serious problems when you try to open bank accounts or raise capital. The next pillar is to build a robust bookkeeping and accounting system from day one. Using a personal spreadsheet might work for a hobby, but not for a serious company. You should choose cloud accounting software that connects directly to your business bank account. Every transaction must be categorized correctly to support your tax filings and financial statements. This real-time bookkeeping enables you to estimate profits and plan quarterly tax payments. It also provides clean numbers when an investor or lender requests your financials. If you are a foreign owner, your accountant may also need ththese records for Form 5P472. This information return discloses transactions between your U.S. company and its foreign owner. The penalty for filing this form late is $25,000 per year. That is a brutal fine for a startup that ignored basic reporting rules. The final pillar is to create a compensation strategy that aligns with your business growth. You need to decide how you will pay yourself as the business generates profit. Simply transferring cash from your business account to your personal account is not a strategy. You must document these transfers as either distributions or formal salary wages. Documentation is the only thing that separates a legitimate business from a tax evasion scheme. Review your numbers quarterly to ensure your estimated tax payments are accurate. Underpaying your taxes throughout the year will trigger automatic penalties from the IRS. Overpaying destroys your cash flow and starves your company of growth capital. You should understand the safe harbor rules that prevent underpayment penalties when income increases. A short strategy session with a competent tax advisor can save you years of headaches. The tax code is designed to reward those who are organized and proactive. It aggressively punishes entrepreneurs who are disorganized or reactive to deadlines. Building a compliant business in 2026 requires attention to detail and professional guidance. Use this as general education, not individual legal or tax advice for your specific startup. Do not let a preventable tax error destroy the business you are working hard to build. Subscribe to Tax and Borders for weekly breakdowns of U.S. tax, banking, and global structures.